In this market update, I'm going to be talking about whether bonds are attractive and are bonds more attractive than stocks at this point. Hi, Jim Gore from THOR Wealth Management. People always ask, is the stock market expensive or not? But one of the things that they also have to do is compare it versus other investments. And one of the big investments is bonds. So that's what I want to talk about here is, are bonds or stocks more attractive at this point? Well, first of all, let's look at what stocks have historically given us on yield. And this is looking at historically going back to 1950s. You can see back in the 50s, you were getting over 7% yield on stocks. As a matter of fact, at the beginning of the 80s, you were getting over 6% yield. So when people talk about the long-term returns for the stock market is 10 to 11%, well, that's pretty easy to get when you're getting a 7% yield. However, if you look at the yield today, it is under 1.5% for the S&P 500. So you're really not getting paid a lot on the yield perspective. So you need to have higher appreciation or basically PE expansion in order for you to get that 10% rate of return. So that is just looking at the yield itself, but you have to compare it to the yield that's available out there from other investments. And what we're looking at in this chart is the 10-year yield divided by the S&P 500 dividend yield. And you can see their big spike up back in 1999. You were getting 500% higher yield investing in 10-year treasuries than you were in the stock market. There was a real outlier that was saying you should invest in bonds at that juncture and not into the equity market. Well, look at 2009, 2010 to 2018. It was actually the yield on bonds was not very good. And that's when people were saying, hey, why should I own bonds? Fixed investment, fixed income. Well, yeah, it was fixed, but you weren't getting much in income. But look at what has happened here recently. You are now getting 2.5 times higher yield on 10-year treasuries than you are on stocks. So bonds are becoming a lot more attractive. And it's actually one of the higher points if you take out 1998, 1999, which was an outlier. Bonds are looking very attractive compared to equities from a yield perspective. But also, one of the things is for investing, you have to look at what the market sentiment is out there. And this chart here, this is looking at optimism for those buying bonds versus optimism those wanting for stocks. And the optimism for stocks over bonds is the highest it's been in 24 years. It only gets up to this level of 4% at a time, and it's one of the highest readings we've ever seen. So this is saying investors are more excited about stocks than they are bonds, even though bonds, as I showed you fundamentally, are giving you much higher yield than they are versus the equity market. So bonds are a lot more attractive now. And sentiment like this is a good contrary indicator. You want to go the other way. So this is telling us that the sentiment out there is too excessive for stocks over bonds. And when that reverts, bonds will outperform the stock market. This last chart is really looking at what THOR does internally. And this is what our indicators, and it's very simple form. There's a lot more that goes into it behind the scenes. But this is looking at duration and also credit risk in the bond market. Now we go from a -3 to a +3, and neutral is 0. If it's positive, that means you want to be there. So if you look at duration, we're about 1.75. Duration means we want to be a little bit longer maturities right now. So duration is maturities. Do I want to own a 1-year treasury or a 30-year treasury? So we actually extended duration, and this actually moved positive back last year in October. We actually were moving money further out along the curve because we were getting paid to do so. Both of these indicators 3 years ago were in the -2 spot. Credit risk, on the other hand, is do I buy a treasury where there's no credit risk, I'm going to get paid back, or do I buy a high yield bond that could not pay me back because of recession and it goes in bankruptcy? Credit risk is still negative. So this is telling us, yes, bonds are more attractive. We've seen that earlier versus the equity market. But also you want to be a little bit longer in duration in those bonds, but you don't want to take credit risk at this juncture. If you have any questions or concerns, always reach out to us at our website, thorwealthmanagement.com, or give us a call. Take care and talk to you in a couple weeks.